Question 1. What is the main advantage of a high deductible health per AHP compared to other health insurance plans? They lower monthly premiums and higher out-of-pocket costs. B. Higher monthly premiums and lower out-of-pocket costs. C. Broader coverage for preventive services and specialty care. D. Coverage for maternity and newborn care with no deductible. Answer A. Explanation. High deductible health plan initiations typically have lower monthly premiums compared to traditional plans, but come with higher deductibles and out-of-pocket costs for care. These plans often pair with health savings accounts (HSAs), allowing individuals to save money tax-free for future healthcare expenses. The higher deductible means individuals are responsible for more of the costs before insurance coverage kicks in, but the lower premiums can make them more affordable in the short term for individuals who are generally hella HSAs to cover preventive services, but the benefit is not exclusive to this type of plan. Other plans like PPOS and HMOS may offer similar or broader coverage for specialty care and preventive services. Question 2. Mr. Thompson recently received an urgent medical bill from a hospital after being treated for a sudden illness. His health insurance provider has denied part of the claim, citing that some of the services were out of network, even though the hospital is part of his provider's network for emergency care. What should Mr. Thompson do? A. Pay the full bill and dispute the charge later with his insurance company. B. Request review of the claim and provide evidence that emergency services are covered under his in-network benefits. C. File formal complaint with the Department of Banking and Insurance, DOBI, in New Jersey without contacting the insurer. D. Accept the denial and look for different insurance plan in the future. Answer B. Explanation. Under the Affordable Care Act, insurance plans are required to cover emergency services without prior authorization or regard for whether the healthcare provider is in-network or out-of-network. This is known as Emergency Medical Services Coverage Rules. Mr. Thompson should request a review of the claim by submitting evidence, such as documentation showing that the hospital was part of his insurance plan's network for emergency care. New Jersey's insurance regulations support the protection of consumers in these situations. If the insurance company fails to reverse its decision, Mr. Thompson can escalate the issue by filing a grievance with his insurer or contacting the New Jersey Department of Banking and Insurance, DOBI. However, he should first pursue the internal claims review process. Question 3. Which of the following is an example of a coordination of benefits (COB) provision in healthcare insurance? A. A primary insurer covers the first $500 of a $1,000 medical bill, and a secondary insurer covers the remaining $500. B. A primary insurer denies coverage for a claim, and a secondary insurer covers the entire bill. C. A single insurer applies a 20% coinsurance requirement on all claims, regardless of other coverage. D. A primary insurer automatically sends the claim to a secondary insurer for payment. Answer A. Explanation. Coordination of benefits (COB) is a provision in healthcare insurance that determines how multiple insurance plans will pay for a covered service when an individual is covered by more than one plan. COB ensures that the total benefits provided by all insurers do not exceed the actual cost of the healthcare services. In this case, the primary insurer covers the first portion of the medical bill, in this example $500, and the secondary insurer covers the remainder up to the total cost. The goal of COB is to prevent overpayment for claims and to clarify which plan is responsible for the primary payment. The other options describe scenarios that either violate COB principles or do not align with how COB typically works. Question 4. Which of the following healthcare insurance provisions is required under the Affordable Care Act for all insurance plans in New Jersey? A. Coverage of all elective cosmetic surgeries. B. Coverage of essential health benefits, including preventive services. C. Elimination of out-of-pocket costs for all prescription medications. D. Automatic enrollment for all individuals in Medicaid. Answer B. Explanation. Under the Affordable Care Act, all insurance plans must cover essential health benefits, which include a wide range of services such as emergency services, preventive services, maternity and newborn care, mental health services, and prescription drugs. These aids ensure that individuals have access to comprehensive coverage for a broad set of healthcare needs. New Jersey has adopted these provisions, which are in line with federal requirements. Cosmetic surgeries are generally excluded from coverage unless they are medically necessary. Automatic Medicaid enrollment is not a requirement of the account, and while prescription drug coverage is required, it does not eliminate out-of-pocket costs entirely. Question 5 MS. Williams has a PRP but she is considering switching to an HMO plan. Which of the following is a key difference between these two types of plans? A. EPO plans typically require members to get a referral from their primary care physician before seeing a specialist. B. HMO plans offer more flexibility in choosing healthcare providers and specialists. C. PPO plans allow members to receive care from out-of-network providers at a higher cost. D. HMO plans cover emergency services only within a specific geographic area. Answer C. Explanation. The key difference between a PO and HMO plan is that PPO plans allow members to see out-of-network providers at a higher cost, whereas HMO plans generally require members to receive care from in-network providers except in emergency situations. PPOs offer more flexibility in choosing healthcare providers and specialists, including those outside of the network, but at higher out-of-pocket costs. In contrast, HMO plans usually do not cover out-of-network services except for emergencies. PPO members do not need a referral to see a specialist, while HMO members typically need a referral from their primary care physician to see a specialist. Question 6. Mr. Sanchez is seeking coverage under Medicaid in New Jersey. Which of the following criteria is used to determine his eligibility? A. All individuals must pass an income test regardless of their health status. B. Medicaid eligibility is based solely on age, with all adults automatically eligible. C. Medicaid eligibility is determined by income, household size, and other factors such as disability status. D. Individuals with employer-sponsored insurance are automatically ineligible for Medicaid. Answer C. Explanation. Medicaid eligibility in New Jersey is determined by several factors including income, household size, and other criteria such as age, pregnancy status, and disability. The state uses modified adjusted gross income measure to assess income eligibility for most individuals. Medicaid expansion under the ACA has allowed more low-income adults to qualify, especially those who meet certain income and household size criteria. While employer-sponsored insurance may affect eligibility for Medicaid, it does not automatically disqualify someone. Age alone does not determine eligibility. Individuals must meet income and other requirements. Question 7. Which of the following best describes the coordination of benefits (COB) process when a person is covered by two health insurance plans? A. The primary insurer pays the full claim and the secondary insurer does not cover any costs. B. The secondary insurer pays the entire claim once the primary insurer has made a payment. C. The primary insurer pays first, and the secondary insurer pays the remaining costs up to the total allowed amount. D. Both insurers pay equally, covering 50% of the total claim each. Answer C. Explanation. Coordination of benefits (COB) is a process used when a person is covered by more than one insurance policy. The primary insurer is responsible for paying first, and the secondary insurer pays the remaining costs, but only up to the total allowed amount. The goal of COB is to ensure that the total payment for the claim does not exceed the cost of the services provided. This process avoids overpayment and ensures that both insurers share the financial responsibility appropriately. The secondary insurer does not pay the entire claim unless the primary insurer's payment is less than the total cost. Question 8. Which of the following provisions is required under the Health Insurance Portability and Accountability Act? HIPAA A. Employers must automatically provide health insurance to all full-time employees. B. Health insurers must provide full access to medical records for third parties without patient consent. C. Health insurers must protect patient information and limit disclosures to only authorized parties. D. Health insurers must allow patients to appeal any denied claims directly with the Department of Insurance. Answer C. Explanation. The Health Insurance Portability and Accountability Act (HIPAA) mandates that health insurers and healthcare providers protect patient privacy by securing personal health information and limiting disclosures to only those parties authorized by the patient or by law. HIPAA sets national standards for the protection of health information and establishes rules for how this information can be used and shared. It does not require employers to provide insurance or allow patients to appeal directly to the Department of Insurance. Additionally, HIPAA strictly controls the disclosure of medical records, ensuring they are not shared with third parties without patient consent. Question 9. Which of the following is a requirement for health insurance plans to be considered compliant with the Affordable Care Act (ACA) in New Jersey? A. Coverage for individuals with pre-existing conditions is excluded. B. Plans must offer a basic minimum level of coverage, including mental health and substance abuse treatment. C. Health insurance plans can limit the amount of coverage provided for preventive care services. D. Health insurers can set lifetime or annual dollar limits on essential health benefits. Answer B. Explanation. Under the Affordable Care Act, health insurance plans must cover a set of essential health benefits aid which include mental health and substance abuse treatment, preventive services, prescription drugs, and other critical care. The ACA also prohibits the exclusion of coverage for individuals with pre-existing conditions and eliminates annual or lifetime dollar limits on essential health benefits. Health insurance plans cannot place limits on the coverage of preventive care services. This ensures that individuals have access to comprehensive care for a wide range of health needs. Question 10. Which of the following is a primary benefit of using a health savings account (HSA) in conjunction with a high deductible health pay? HSA allows for tax-free contributions that can be used to pay for out-of-network care only. B. The HSA funds can be used to cover eligible healthcare expenses and unused funds roll over year to year. C. The HSA is primarily used to cover monthly premiums, reducing upfront healthcare costs. D. The HSA offers a guaranteed monthly payment for healthcare expenses regardless of need. Answer B. Explanation. A health savings account (HSA) is often paired with a high deductible health plan. The primary benefit of an HSA is that individuals can make tax-free contributions to the account, which can then be used to pay for eligible healthcare expenses, including those for deductibles, copayments, and coinsurance. Unused funds in a HSA roll over from year to year, providing long-term savings for medical costs. HSAs do not cover premiums directly and are not designed to offer guaranteed payments for healthcare expenses. The funds can be used for both in-network and out-of-network care as long as the services are eligible. Question 11. Which of the following types of life insurance provides coverage for a specified period of time and pays a benefit only if the insured person dies during that period? A. Whole life insurance. B. Term life insurance. C. Universal life insurance. D. Variable life insurance. Answer B. Term life insurance. Explanation. Term life insurance provides coverage for a specific period, such as 10, 20, or 30 years. If the insured dies within that period, the beneficiary receives the death benefit. If the insured survives the term, there is no payout. Whole life, universal life, and variable life insurance are permanent life insurance policies that offer lifetime coverage and often have a savings or investment component. Question 12. Which of the following is typically not covered under a standard homeowner's insurance policy? A. Fire damage to the structure of the home. B. Theft of personal property. C. Flood damage. D. Liability for injury on the property. Answer C. Flood damage. Explanation. Standard homeowners insurance policies generally cover fire damage, theft of personal property, and liability for injuries on the property. However, flood damage is typically not included in a standard homeowners policy. Homeowners must purchase separate flood insurance through the National Flood Insurance Program and FIP, a private insurer. Question 13. What is the main purpose of the subrogation clause in an insurance policy? A. To limit the amount of coverage for a specific event. B. To allow the insurer to pursue a third party to recover costs paid on behalf of the insured. C. To provide coverage for lost income due to disability. D. To waive the deductible for certain types of claims. Answer B. To allow the insurer to pursue a third party to recover costs paid on behalf of the insured. Explanation. Subrogation allows an insurance company to pursue recovery of costs from the third party that is responsible for the damage or loss. For example, if the insurance company pays for an accident caused by another driver, the insurer may seek reimbursement from the at-fault party's insurance company. This helps the insurer recover its costs and prevents the insured from being compensated twice. Question 14. Which of the following is a characteristic of a health maintenance organization (HMO) insurance plan? A. It offers a wider range of healthcare providers, including out-of-network options. B. It requires referrals from a primary care physician (PCP) for specialist care. C. It allows members to seek care without coordination or pre-authorization. D. It has higher premiums and lower out-of-pocket costs compared to PPO plans. Answer B. It requires referrals from a primary care physician (PCP) for specialist care. Explanation. HMO plans typically require members to choose a primary care physician (PCP) who coordinates all of their care. If the member needs to see a specialist, they must first obtain a referral from their PCP. This type of plan often has lower premiums and out-of-pocket costs, but offers less flexibility than PPO plans, which allow more freedom to see specialists without referrals. Question 15. In New Jersey, what is the maximum amount an individual can contribute to a health savings account (HSA) in 2025? A. $2,500. B. $3,600 for individuals and $7,200 for families. C. $4,000. D. $10,000. Answer B. $3,600 for individuals and $7,200 for families. Explanation. In 2025, the IRS allows individuals to contribute up to $3,600 to an HSA and families to contribute up to $7,200. These contribution limits may be higher for individuals over the age of 55 who are eligible for a catch-up or contribution, which adds $1,000 to the limits. Question 16. Which of the following is a benefit of a traditional individual retirement account era? A. Contributions are made with after-tax dollars and withdrawals are tax-deferred. B. Contributions are made with pre-tax dollars and withdrawals are tax-free. C. Contributions are made with after-tax dollars and withdrawals are tax-free. D. Contributions are made with pre-tax dollars and withdrawals are taxed as ordinary income. Answer D. Contributions are made with pre-tax dollars and withdrawals are taxed as ordinary income. Explanation. A traditional era allows individuals to contribute pre-tax dollars, meaning they can deduct the contribution from their taxable income in the year it is made. However, when funds are withdrawn in retirement, they are taxed as ordinary income. This provides a tax advantage in the years when contributions are made but taxes are due on withdrawals. Question 17. In the event of a claim under a standard auto insurance policy, which of the following coverage types would help pay for the damages to the insured's car after collision, regardless of fault? A. Comprehensive coverage. B. Collision coverage. C. Liability coverage. D. Personal injury protection (PIP). Answer B. Collision coverage. Explanation. Collision coverage pays for damages to the insured's car following a collision, regardless of fault. This type of coverage is often optional but is commonly required by lenders or leasing companies. Comprehensive coverage, on the other hand, covers damage to the vehicle caused by events other than a collision, such as theft or weather-related damage. Question 18. What does the term deductible refer to in an insurance policy? A. The amount the insurer will pay for a claim after coverage limits are reached. B. The amount the insured must pay out of pocket before the insurance company begins to pay. C. The percentage of the claim that the insured must pay. D. The amount the insurer will charge for the policy each month. Answer B. The amount the insured must pay out of pocket before the insurance company begins to pay. Explanation. The deductible is the amount the insured must pay out of pocket before their insurance coverage begins to pay for a claim. For example, if an individual has a $1,000 deductible and files a claim for $5,000, they would be responsible for the first $1,000 and the insurer would cover the remaining $4,000 depending on the terms of the policy. Question 19. Under the Fair Credit Reporting Act of CRA, what is a consumer's right regarding their credit report? A. Consumers must pay fee to obtain their credit report. B. Consumers are entitled to one free credit report per year from each of the three major credit bureaus. C. Consumers cannot dispute errors on their credit report. D. Consumers must wait 60 days to correct errors in their credit report. Answer B. Consumers are entitled to one free credit report per year from each of the three major credit bureaus. Explanation. The Fair Credit Reporting Act (FCRA) entitles consumers to one free credit report per year from each of the three major credit bureaus, Equifax, Experian, and TransUnion. This allows individuals to monitor their credit history and ensure that there are no errors. Consumers also have the right to dispute errors on their credit reports. Question 20. What is a primary feature of a flexible spending account (FSA)? Contributions are made with pre-tax dollars, but funds do not roll over year to year. B. Funds can be used to pay for any type of medical expense. C. Contributions are made with after-tax dollars, and funds roll over at the end of the year. D. The account is tied to an employer-sponsored health plan, but contributions are not tax-deductible. Answer A. Contributions are made with pre-tax dollars, but funds do not roll over year to year. Explanation. A flexible spending account (FSA) allows employees to contribute pre-tax dollars to pay for eligible medical expenses. However, unlike a health savings account (HSA), the funds in an FSA generally do not roll over from year to year. Any unused funds may be forfeited at the end of the plan year, although some plans may offer a small grace period or allow a limited rollover amount. Question 21. Which of the following is typically covered under a standard homeowner's insurance policy? A. Damage to the home caused by earthquakes. B. Theft of personal property within the home. C. Personal injury to the homeowner caused by their own negligence. D. Injuries sustained in a public place. Answer: B. Theft of personal property within the home. Explanation: Standard homeowners insurance generally covers damage to the home, including theft of personal property inside the home. However, damage caused by earthquakes is typically excluded and would require a separate policy. Personal injury from the homeowner's own negligence is generally not covered, nor are injuries that occur in public places. Question 22. Which of the following best describes the role of an actuary in the insurance industry? A. Selling insurance policies to consumers. B. Setting premium rates based on statistical data. C. Administering claims for policyholders. D. Underwriting insurance policies for high-risk individuals. Answer: B. Setting premium rates based on statistical data. Explanation: An actuary uses mathematical and statistical methods to assess risk and determine the appropriate premium rates for insurance policies. They analyze data to predict the likelihood of events such as accidents or natural disasters and help insurers price policies accordingly. Question 23. In an auto insurance policy, which of the following coverages is typically responsible for paying medical bills resulting from an accident, regardless of fault? A. Liability coverage. B. Collision coverage. C. Personal injury protection (PIP). D. Uninsured motorist coverage. Answer: C. Personal injury protection (PIP). Explanation: Personal injury protection (PIP) covers medical bills and other related expenses for the insured and passengers in the event of an accident, regardless of who is at fault. This may include hospital bills, lost wages, and other costs related to the injury. PIP is available in no-fault states, while other states may offer similar coverage under different names. Question 24. Which of the following is an example of a rider in an insurance policy? A. A clause that excludes specific types of coverage. B. A policy endorsement that adds additional coverage for a specific item or event. C. A standard clause that applies to all policyholders. D. A type of insurance sold by an agent. Answer: B. A policy endorsement that adds additional coverage for a specific item or event. Explanation: A rider, also known as an endorsement, is an amendment to an insurance policy that adds coverage for specific items or events not covered under the standard terms of the policy. For example, a jewelry rider could be added to a homeowner's policy to cover expensive jewelry that exceeds the policy's standard limit. Question 25. Which of the following would be considered a hard inquiry on a consumer's credit report? A. Checking your own credit score. B. A pre-approved credit card offer. C. Applying for a new credit card. D. Reviewing your credit report for inaccuracies. Answer: C. Applying for a new credit card. Explanation: A hard inquiry occurs when a lender checks your credit report as part of a decision to grant you credit. This type of inquiry can affect your credit score. Other activities, such as checking your own credit or receiving a pre-approved offer, are considered soft inquiries and do not impact your credit score. Question 26. What is the primary purpose of an umbrella insurance policy? A. To provide additional coverage for a specific item, such as a car or home. B. To cover claims not covered by other insurance policies, such as auto or homeowners. C. To offer medical coverage for injuries sustained in accidents. D. To cover damages from natural disasters. Answer: B. To cover claims not covered by other insurance policies, such as auto or homeowners. Explanation: An umbrella insurance policy provides additional liability coverage above and beyond the limits of other insurance policies, such as auto or homeowners insurance. It is designed to protect the policyholder from major claims and lawsuits that could exceed the limits of their primary insurance. Question 27. Which of the following is true about a universal life insurance policy? A. It provides early term life insurance coverage. B. It allows the policyholder to adjust both the premiums and death benefits. C. It has fixed premiums and fixed death benefits. D. It does not accumulate any cash value. Answer: B. It allows the policyholder to adjust both the premiums and death benefits. Explanation: universal life insurance is a flexible, permanent life insurance policy that allows the policyholder to adjust the premium payments and death benefits within certain limits. Additionally, it has a cash value component that can grow based on interest rates or investment performance. Question 28. Which of the following is typically covered under the collision portion of an auto insurance policy? A. Damage to the insured vehicle caused by hitting a tree. B. Theft of the vehicle. C. Damage to the insured vehicle caused by a natural disaster. D. Damage to another driver's vehicle. Answer A. Damage to the insured vehicle caused by hitting a tree. Explanation: collision coverage pays for damages to the insured vehicle caused by a collision with another vehicle or object, such as a tree or a guardrail. It does not cover theft, natural disasters, or damages to other vehicles, which would be covered by liability insurance. Question 29. Which of the following is generally excluded under a standard homeowner's insurance policy? A. Fire damage to the house. B. Vandalism damage to the house. C. Water damage due to a burst pipe. D. Water damage due to flooding. Answer D. Water damage due to flooding. Explanation: standard homeowners insurance typically covers fire damage, vandalism, and water damage from a burst pipe. However, water damage due to flooding is generally excluded and requires a separate flood insurance policy, which can be obtained through the National Flood Insurance Program (NFIP). Question 30. Which of the following insurance policies is specifically designed to provide compensation for lost wages due to an illness or injury? A. Disability insurance. B. Term life insurance. C. Long-term care insurance. D. Critical illness insurance. Answer A. Disability insurance. Explanation: disability insurance provides income replacement for individuals who are unable to work due to illness or injury. It can be short-term or long-term and typically compensates a portion of the individual's regular income during their period of disability. Long-term care insurance provides coverage for extended care, while critical illness insurance provides lump sum payments upon diagnosis of specific illnesses.